how is it actually designed to benefit professionals in the trade and transaction banking sector?
But then, of course, you're looking at the risk for the banks as well. You're looking at the different parties and the different risks associated. So not just one aspect, not only the banks.
There are a lot of courses in trade finance and trade products and commodities and very specific risk areas such as trade-based money laundering and sanctions monitoring.
Hi, I'm Brian Keenup, Assistant Editor at Trade Finance Global.
I'm Alex Gray, Director of Trade and Transaction Banking at LIBF.
And Peter Milne, freelance trainer and consultant.
Welcome to Trade Finance Talks, your go-to trade, treasury and payments podcast, brought to you by TFG.
Hi, and welcome to Trade Finance Talks. My name is Brian Keenup, Assistant Editor at Trade Finance Global. We all know that international trade is what makes the world go round. Without it, I would not be here recording this podcast, and you would not be listening to this podcast on whatever device you're using. The extreme vastness of this industry is precisely what makes it so fascinating, and at the same exact time, so risky. It is easy to see how the various risks can pop up along the international trade process, ranging from physical commodity trading to shipping and storage and distribution, all the way to the final sale. There are many ways where the process can go wrong. According to PwC's study, across 53 countries, over 51% of those companies experienced some sort of fraud. The ICC estimates that if even 1% of the approximately $5 trillion of global trade financing market is susceptible to fraud, and assuming only 10% of those transactions will lead to losses, this still amounts to an annual cost of around $5 billion in total business disruptions. It's a lot of money. That is why understanding risk and risk mitigation is one of the most important aspects of working international trade. And there's no better way to learn about this than the LIBF Certificate in International Trade Risk. And I'm happy to introduce Peter Milne and Alex Gray, Director of Trade and Transaction Banking, LIBF. Peter, Alex, welcome to Trade Finance Talks.
Hello.
So let's do a quick introduction for both of you. Who are you? Where are you from? What do you do?
I'm Alex Gray, Director of Trade and Transaction Banking at LIBF. Joined January 2020, just with the attraction of lots of global travel. And obviously that didn't quite happen. I've been doing a lot of meetings on the internet, and it's good to be back out and about interacting with people. But before that, I spent 30 years in banking, predominantly in HSBC on the trade side and also with Santander. And that's actually where I met Peter.
Hi, Peter Milne. I'm a freelance trainer and consultant. Alex said, we were both at HSBC. I spent almost 40 years there, having originally joined Milne Bank in West Yorkshire. I subsequently had several business and corporate relationship manager roles and a period as a credit risk manager in and around London, in all of which I specialised in trade finance. Following the financial crisis in 2008, HSBC, like other international banks, had an increase in trade-related problem loans. I was a corporate banking manager at the time with a portfolio of large international trading and commodity customers. Because I had experience at trade finance, trade operations, credit and insolvency processes, I was part of the team that sought to minimise exposure and losses. And that led to the creation of a new role and team which I headed up to oversee and manage the core trade risk for HSBC in the UK, and I ran that team for several years until I left HSBC.
And I remember when you joined, I was actually asked to meet Peter, then soon to be mutual boss Ian Tandy, who's now in Singapore. And he said, can you have a wee word with Peter? I'm thinking about setting up this thing. He'd done this kind of thing before. At the start, it was just yourself, Peter, wasn't it? As the team grew and grew over the weeks and months, and there's quite a few people that have come through that team and are doing very well around the HSBC and elsewhere, because it's a very good basis for learning everything there is about trade and banking.
Yeah, started off with just me and then one other, and then we grew the team to 6 over several years. And in that time, there probably 20 people worked in the team. It was a real place to get experience and to get to understand the sort of thing we're going to talk about today, understanding risk in all its forms across the whole panoply of trade finance.
That's when we were looking at LIBF about doing this qualification, CITR. It's got to have 4 letters and start with a C. And it's probably got an I in it for the international bit. When we looking to set that up, we were actually asked about a trade risk qualification by some of our partners, especially in China. CCPITs and China Council for Promotion of International Trade, and they were asking about a risk, and I was like, it didn't quite I thought, well, everything's about risk. But then that's where I thought, well, I'll give Peter a call. We could discuss about how it could potentially look, and that's where he came up with the outline. I don't think he realized he was going to be doing a podcast about 6 months later, but here he is. I thought there was no better person to be having set that up at HSBC. Of course, they're a very well-renowned bank, even though maybe would be slightly biased. From that, when Peter's doing the outline, we went around the world and got various people to contribute to it. I can talk about that later.
Yeah, I'd actually be very curious. You mentioned this outline. Could you give, just not to go into complete detail, a little bit of an overview of the key components and the structure of the CITR program?
Yeah, well, one of those things when you start writing it, you have a few things and it starts to grow because, you think as a trade person, you know the few obvious things like credit risk, performance risk, sovereign risk, and then you start writing them down and then it gets more, and then obviously ESG, which probably wouldn't have been put there like 10 years ago.
Not at all.
That's a bit newer thing. So the last one we cover in the whole over profile on the this is risk by the importers and exporters, is like cyber risk. So that's keeping up to date. But then, of course, you're looking at the risk for the banks as well. You're looking at the different parties and the different risks associated. So not just one aspect, not only the banks, because you have to be thinking about what the customers will be doing and having an understanding of the full picture there.
Now that you give that brief overview of the actual program, how is it actually designed to benefit professionals in the trade and transaction banking sector? We always like to talk about things in a theoretical way, but it's really good to nail it down sometimes in a concrete, tangible way. Could you talk about this a little bit?
Yeah, I mean, I've been doing freelance training and a bit of consultancy for almost 7 years now, since I left HSBC. And within the sector generally, there are a lot of courses on trade finance and trade products and commodities and very specific risk areas such as trade-based money laundering and sanctions monitoring. Alex outlined just a few seconds ago, there are a wide range of risks that impact on trade finance. This qualification covers in significant detail many, many more of those risks, enabling the students, the associates, to identify and, very importantly, to understand these risks and also the risk mitigation options. So it's a very holistic objective of this qualification. Whilst I was undertaking my portfolio risk management role just before I left HSBC, I used to put together courses for credit risk officers. But even at that time, I appreciated there were lots of other departments that were involved in risk. You've got compliance risk departments, legal, regulatory, and reputational risks. But trade risk is all of these and more. So those whose roles involve looking at trade proposals or transactions from any of these areas, I feel need to understand the way in which these risks interconnect, overlap. Because if you don't have a full picture, then something is likely to fall between the stools.
It's pretty clear that this isn't just meant for junior entry-level individuals as well. This type of program and these type of risks can be really useful for anyone to learn about, regardless of seniority.
It's interesting because, Peter, we're using the word students, and now you're thinking, is that the right word? I struggle with that word because everybody that does a qualification at LIBF has already been a student. They've had a backpack and they've hung out at the refectory. Whereas now, these are all people who are professional. This part of LIBF is the professional education.
I think the point you were coming to, about that you can be at any stage in your career. This is some training will enhance whatever you're doing. For those more junior members of organisations, it will give them some insight into opportunities, perhaps. But for those more senior, it just gives them a broader perspective, which I think is often missing.
But with our qualifications, we tend to have you almost split it down into two types of audiences. There's the audience that already has been in trade. So people like Peter and myself, that, I did the compliance qualification, CTFC. You're meant to study for 200 hours. For this one, actually, we're looking at about 130 hours of total work. But if you were in the risk function, say like one of Peter's young Padawans, they didn't being the Jedi, they probably wouldn't have to do that much, but they'd have to make sure that they were comfortable with the content they were reading. So those people were wanting to prove to other people that they know about trade risk. And then they have the other people who don't know anything and having to do more in-depth study. Most of our qualifications are sort of split down. People who have the knowledge and need to display it to people, or people who are wanted to learn out. We've seen people been told they have to pass the qualification for their probation. It's on a certain amount of pressure. But here, that was for CITF. But here, for this qualification, we've got a diagnostic tool set up because we don't want people to do it and then set them up to maybe it wasn't appropriate for them to do. So anybody that has our CITF, Certificate of International Trade Finance qualification, will be able to do CITR. But if you haven't got that, we'll ask you to do a small test, 30 questions, 30 minutes. If you know it, you probably would take way less than 30 minutes. And then if you pass that with like 70%, then you would be able to do CITR. We don't want people going to do what this is a level 4 qualification, so almost like an A level or maybe first year uni, at least first year Scottish uni before Peter remarks on the difference. But we want the right people to do the qualification. So CITF is a broad overview and CITR is more focused. So we're looking at people who need that more focused qualification. That every one of our qualifications looks at risk in some aspect, but this is very much focused on the overall piece, and it will enable people to have a much better understanding, and also some people who have it to display that they have that.
It is difficult to keep up with all different trends and risks going on in international trade. I mean, think of the past 4 years, let's say, and really that's a short amount of time, but think much has changed since then. So you're looking at global events such as the COVID-19 pandemic, geopolitical tensions, I mean, so many different risks across the world. How does CITR program reflect these changes and even attempt to keep up with modern challenges and changes?
Well, what's interesting about COVID was that it sort of differentiated banks that are maybe prepared for certain risks compared to others. You know, Peter and I were talking earlier about, we had our BCPs, but business contingency plans, and boy, was it dull having to go through those things. There's a reason why you do it. I mean, when I worked in Taiwan, we had a drill for evacuating the building in the event of an earthquake. And my colleagues didn't take it that seriously and tried to be outside when they knew it was happening. I had to sort of mention it to somebody because I didn't feel that they were practicing properly. I'm one of those people that practice for the worst. Hopefully that won't happen. But with COVID, it did happen. And therefore, the banks that had those contingency plans in place were able to put things in quickly. Some that didn't would maybe realize, hopefully they've learned from their mistakes. So there's a much bigger realization of risk from the COVID piece, but then there's also about wars and how that changes the whole landscape. So obviously Russia, Israel, all that's, there's conflicts that are going on. And so people are looking at, having seen how, say, Russia affects with sanctions, and how will other things change the whole supply chain. So, people are nearshoring, so maybe moving production from, say, Asia back into Europe, in a European context, because it gets things done more quickly and better in terms of time zones and everything. But there's also that piece about preparing for various risks, not putting all your eggs into one basket. So I think with it in the past few years, what's interesting for Peter and I is that people have a bit of an understanding now about maybe more about what we do within banking. But also, for example, when that Evergreen ship got stuck in the Suez Canal, I was explaining to people this was actually part of this kind of stuff we were looking at. And I could show them from maritime shipping, you could see where the roadblocks and how everything was condensed around one point. So it brings to life more what we're doing, how it actually affects like the world's trade. It makes it more interesting for me, to be honest. So I would say, in summarizing that, is that more people are more aware of those risks than they would have been in the past.
Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it.
I think if an average person not working in industry picked up a newspaper in the past 2 years, it's becoming a lot clearer that these risks affect people every day. You don't only have to be reading, Bloomberg behind a gated subscription. Now it's popping up front page of BBC, Financial Times, and New York Times. Yeah. It's amazing to see that type of coverage, and people are realizing their cars may get delayed by 3 years because of something going on in the Red Sea. I don't think that was being covered nearly as much before this recent wave of insecurity.
Yesterday, there was just a report on the radio about the cost of shipping a container from Asia. It's up to about $4,000 now, just for a container. So people maybe have more awareness of these types of issues. It was only us people in trade that would have known that about 20, 30 years ago what these things cost, but it's more prevalent.
It's fascinating, and it's it's unfortunate that we've gotten to the point where it needs to be covered, but at least now people will know a bit more about it.
And that logistics risk is one of the very core areas that you look at. As Alex has said, if you're in the trade environment, it was something you were continually aware of. And not just prices rising, because the prices rising, and there's a shortage of containers. Goods do not move. And then you get delays, then you get knock-on effects. So that's a very good example of one of the areas that is probably not aware by a lot of people who are not regularly involved in trade, but is one of those key parts of this qualification.
I had a really interesting customer when I was in Vancouver, actually based in Chicago, and they were shipping soy grain, soy beans from the States over to China. They were doing normally through a container, but then the container prices went up. They realized that there's all these empty containers in Chicago that come from Asia. So they actually shipped the soy back in the container. So that explained why when I was in Taiwan moving my personal effects back, there was all this kind of grain stuff in it, because they would get a cheaper shipment. So as opposed to putting everything in a one big bulk vessel, they would just use hundreds of containers that were practically free to send back because they were empty. And they needed to be in China. It's the whole thing with vessels needing to be in the right place. And that's what's happened, with COVID as well. There was things in the wrong place and it doesn't happen instantly where things suddenly rejig around. So, and shrewd customers will take advantage of these things and different methodologies.
And I'm going to put you two on the spot here because my next question is something that none of us can actually do very well. But let's predict the future trends or challenges a little bit. So with both your two experiences and kind of really keen insights, what type of challenges do you predict for international trade risk management? And also second question, Pat, how is the CITR program evolving to address these potential challenges?
I think where you've got to start from is that international trade and trade finance has been around a long time. I mean, it goes back to the East India Company and before, and it is constantly evolving. And as Alex has said, the good customers are fleet of foot and take advantage of that. Whatever comes their way, those business customers in particular, and therefore the bank's going to have to be with them to actually respond and react to those. So in the last year or so, we've had a lot of problems with commodity trading frauds. And now we're starting to see some concerns around cybersecurity. Now, how far is that cybersecurity going to go? Well, we don't really know. You've got to be prepared. It's a bit like a contingency plans. And where I see that the principal challenges coming around the e-commerce solutions, the use of blockchain and AI in transactions. At the moment, there are a small number of very large transactions that are undertaking these blockchain transactions. So all the parties involved know each other. And that familiarity with each other, sometimes it can be a curse, but in the main, it's a really good risk mitigant. Where the challenge will come is as that technology develops and it becomes available to a wider audience, and there are a lot more counterparties involved. And that's, as I see it, probably the biggest challenge coming down the track. Now the beauty about this program, it is broken down into sections and modules. They can be adapted or new modules included, so that those coming to do the qualification will be getting the latest input on what the current trends are. So it's a very flexible qualification in that. It's not something you do it now and it's going to be out of date. There will be a lot of information around on what is very current and what is seen down the track. But the thing about risk management is a lot of the benefits come from anticipation. It's anticipating how you may have to use a range of skills that are going to be developed from this program. The individual topics may not be covered, but the program will teach you how various areas overlap, interconnect, and how you join those bits together. It's like putting a jigsaw together. That's how I see it.
There's definitely on the tech side, because more technology is coming in, and some of the listeners will know that I work for a tech company. So talking about the whole piece, because it's, for example, like bills of lading and that type of stuff, all these things will make the whole process quicker. So therefore, if the process is quicker, the banks are going to have the risks sort of nailed down to what's going on. So that's where it kind of works. Peter made a good point. With all the qualifications, we look to keep them updated, because everything is now online, and where the textbooks are all there, can be adapted very easily. I know people in the past that prefer a book. It's very difficult to keep a book up to date. So this is why we've moved on to more of the online way. With the technology that's moving ahead, that everything's going to be faster. It's going to enable things to, decisions to be made. I hope my part of that on the tech side is also to reduce some of the stresses, because when I was at HSBC, there was a lot of pressure on the team. So, for example, sanctions, that whole piece is getting more complicated. If you have this tech tools that can enable you to sift through that, because the people that are working in the trade team, the pressure is growing. At a conference recently, they was talking about this sort of concept of perpetual risk, and the fact is that There's just the risk is always going to be there. In the past, maybe 20 years ago in a bank, you'd write a review once a year, and then that's when you'd be looking at everything. But now you're looking at things all the way through the year. And with the use of just simple things like optical character recognition, if you put your credit reports into a system, you're going to be able to identify if there's a problem in, say, I had to choose a country where they cause least offence. But let's say Turkmenistan, and apologies. If something happened in Turkmenistan, you could identify that. Well, Peter and I were talking earlier, when something happened, you'd have to send an email 15, 20 years ago to everybody and say, does anybody have any dealings with Turkmenistan? But now with the technology, you can do that. We talk about the goods and stuff. If you're having dealing in specific goods, the technology would be able to help with that. So I think the technology is going to help. And then the overriding side of the whole risk side, that's where we bring in CITR to help with that.
To wrap up a lot of this conversation here, one more pitch and a bit more information about CITR. Alex, I know you mentioned this a little bit earlier, how it's complementing other courses offered by LIBF. What role do you really see this new qualification playing in the broader context of trade finance education, professional development, and how it also walks alongside many other qualifications offered by LIBF?
With our qualifications, if you have 3 level 4 qualifications, you become QTFS, Qualified Trade Finance Specialist. It's like a diploma. Those people who maybe only have 2 level 4 at the moment, this is another opportunity to have another qualification. People do like that, the QTFS, the diploma aspect, showing that wider learning, because it's for people in trade. They're not so aware of risk. So imagine, Peter, when you were having to train your team up, if they had this kind of qualification, you'd be able to do that in conjunction with doing that work, and they'd have probably a higher learning curve. Of course, you were training all those people up 10, 12 years ago, and there wasn't a tool like this. But that's how CDCS celebrating 25 years, that came about actually from requests at HSBC when I was working there to have a qualification that would help to standardize the approach. That's what in China they've asked about, having an understanding of a global methodology on that trade risk. So our qualifications are looking at that sort of side of a standard approach, because it would make it easier if globally people are adopting a similar approach.
In my team, as you said, we didn't have this qualification. They were all encouraged to do the CITF. And in fact, I think everybody in the team did the qualification and got the benefit, especially if you're doing the qualification alongside your working day. It has a resonance. If we'd had this qualification, I think I would probably have been getting them to do the CITF, but then follow up with this, not necessarily in that role when they were with me, but when they went on to the next role, because most of them, in fact all of them that I can think of, have stayed in the trade arena and would benefit from this additional, but it's a knowledge base. It's not just a qualification, it's a knowledge base, and that's what I think they need.
In terms of the international piece, CITR International, we have deliberately gone out and got contributors not only from England, from a wider field, so Africa and Asia, especially China, where the idea first came up. Like an international blockbuster, you need all these places represented. And we actually haven't got an American, but maybe do an update, get an American involved. The idea is being international, having a broad base of contributors from around the world. And then that will help with us. We'll keep it updated. Because with the release of any new qualification, we'll probably do an update sooner once we get some feedback from people. And for anybody who's doing our course in the end, we're really open to receive any feedback. It'd be great.
Alex, Peter, I want to thank you both for being here on Trade Finance Talks. And I think we had a really good conversation, not just about CITR, but kind of trade finance, and risk as in a holistic way. So I think that really can prove the quality that education that LIBF can bring for everyone. And for the listeners, we will be putting a link to the qualification of the courses in the article in the podcast description. So please, everyone, go check it out. It's fantastic, as you heard here today. So again, Peter, Alex, thank you very much for joining me today, and hopefully we'll be speaking soon.
Well, thank you very much. Thank you.